Welcome to Trade Tactics TV. In today's video, we're diving into two important chart patterns. Rising wedge. Whether you're a beginner or an experienced trader, this video will cover everything you need to know about these powerful patterns and how to use them in your trading strategy. If you enjoy the content, don't forget to like, subscribe, and turn on the notification bell so you never miss out on our latest trading tips and insights. Thank you for watching. In the last class, I discussed the bear pennant, and in today's video, I will show the rising wedge. A rising wedge is a bearish chart pattern, typically indicating a potential reversal in an uptrend. As prices rise within the wedge, the slope of the higher highs and higher lows converge, signaling a weakening momentum. Here's a more detailed explanation. Key elements of a rising wedge. Slowing price increase. As the price rises, the upward movement becomes less steep, reflecting a tapering off of momentum. Decreasing volume and volatility. Both volume and volatility tend to decrease, showing that the buying interest is waning. Converging maxima and minima. The highs and lows of the price range form two trend lines that converge, creating the wedge shape. Potential for reversal. A rising wedge typically signals a possible reversal to the downside when the price breaks below the lower trend line. Trading the rising wedge. Confirmation of the breakout. A trader should wait for the price to break below the lower trend line of the wedge before entering a sell position. This confirms the pattern and signals a bearish trend. Emotional control. It's crucial to avoid emotional decisions and stick to the algorithms or rules of your trading strategy. Buy entry. Although the rising wedge is typically bearish, some traders may consider opening a buy position if there's a break above the upper trend line of the wedge. However, this can be riskier, and it's more common to wait for a breakdown to open a sell position. Target. Setting a target. The target, or where you plan to close the trade, can be determined based on various strategies. A common approach is to measure the height of the wedge at its widest point and subtract this distance from the breakout point, in the case of a sell position. Support or resistance levels. You can also place a target near key support or resistance levels or Fibonacci retracement levels based on the prior trend. Risk management. Always use a stop loss to protect yourself from significant losses, especially in volatile markets. Setting a stop loss is an essential part of risk management in trading. It helps limit your losses by automatically closing your position when the price moves against you. Here's how to set a stop loss effectively, particularly when trading a rising wedge pattern or in general. Identify key support or resistance levels. In a rising wedge, a bearish pattern, the stop loss is typically set above the upper trend line, near a key resistance level. For long positions, when you expect the price to rise, the stop loss can be placed below the lower trend line or a key support level. ATR, Average True Range Method. The ATR indicator measures market volatility and helps you set a stop loss based on the asset's average price movement over a specific period. If the ATR is high, the market is volatile, so the stop loss should be wider. If the ATR is low, the stop loss can be tighter. Example: if the ATR is 20 pips, you might place your stop loss 1.5 to 2 times that distance away from your entry price, i.e., 30 to 40 pips away. Percentage of capital or risk-based approach. Set the stop loss based on the percentage of your capital you're willing to risk on a trade. Typically 1% to 2% of your total trading capital. Example: if you have $10,000 in your trading account and you're willing to risk 2% per trade, your risk per trade would be $200. Based on the position size and entry price, you calculate the distance to set your stop loss in pips or points. Price pattern-based stop loss. For rising wedge. After a rising wedge breakout downward, the stop loss is placed just above the upper trend line or the most recent swing high before the breakout. Example: if the price breaks down from the wedge at $100 and the last high within the wedge is $102, you could place your stop loss slightly above $102. Trailing stop loss. A trailing stop loss automatically adjusts as the price moves in your favor. This allows you to lock in profits while still giving your trade room to grow as the price moves further in the exp. Setting a stop loss is a critical risk management tool that protects you from large losses if the market moves against your position. Here's how to set a stop loss effectively. Identify key levels. Support/resistance levels. The most common approach is to place the stop loss just beyond key support or resistance levels. For a buy position, place the stop loss slightly below the nearest support level. For a sell position, place the stop loss slightly above the nearest resistance level. Trend lines. You can place the stop loss just outside of a trend line, below for an uptrend, above for a downtrend. Recent swing high/low. Use the most recent swing high or low point to set the stop loss. For long trades, set the stop loss just below the most recent swing low. For short trades, set the stop loss just above the most recent swing high. Percentage-based stop loss. Some traders use a fixed percentage of the entry price to set their stop loss. For example, you might set a stop loss 2% below the entry price in a long trade or 2% above in a short trade. This approach helps ensure consistent risk management. Volatility-based stop loss. ATR, average true range. This indicator measures market volatility and can be used to determine an appropriate stop loss distance. For example, if the ATR is 20 pips, you might place your stop loss 1.5 to 2 times the ATR away from your entry price to account for volatility. Bollinger Bands. You can also use the bands to place a stop outside of the upper or lower bands, giving the trade room to breathe. Rising wedge pattern stop loss. Below the recent low. For short, in the case of a rising wedge pattern. If you're entering a sell position after a breakdown, you can place your stop loss just above the last high of the wedge. This ensures you have limited risk in case the breakdown was a false signal. Above the recent high. For long, if you're taking a contrarian long position after a breakout from the rising wedge, riskier. Place the stop loss just below the last low of the wedge. Time-based stop loss. For shorter-term traders, a time-based stop loss may be useful. For instance, you might exit a trade if it doesn't move in your favor within a specified time period, e.g., 1 day or 1 hour, regardless of whether it hit a price stop loss. Risk-reward ratio. Always assess your stop loss in relation to your target. The ideal risk-reward ratio is at least meaning for every dollar you're risking, you expect to make at least $2. If you're risking $100, aim for a profit target of $200 or more. Example for a rising wedge short trade. Entry. Price breaks below the lower trend line of the wedge. Stop loss. Place it just above the last high inside the wedge. Target. Measure the height of the wedge and subtract that from the breakdown point. Example for a long trade. Entry. Price breaks above the wedge. Stop loss. Place it just below the last low of the wedge. Target. Set your target based on key resistance levels or the wedge's height. Summary. Conservative. Stop just above resistance for sell or below support for buy. Aggressive. Volatility or percentage-based stop losses. Rising wedge. Stop just above the last swing high for short or below the last swing low for long. Identifying key support and resistance levels is an essential skill for technical analysis and trading. These levels help traders understand where the price might reverse or pause, allowing them to set entry, exit, or stop loss points effectively. Let's break down these concepts and how to identify them. Support and resistance basics. Support level. This is a price level where the market has shown a tendency to stop falling and bounce back up. It indicates a strong buying interest at that price level. Resistance level. This is a price level where the market has historically struggled to break through, showing that sellers dominate, causing the price to reverse or consolidate. How to identify key support/resistance levels. Historical P.